Wall Street just crossed the Rubicon. JPMorgan, Goldman Sachs, BlackRock, and Vanguard tokenized real stocks for the first time ever on the DTCC network. This is not a test. This is the biggest institutional crypto move in history. Here's what happened. On August 10, 2026, JPMorgan tokenized a portion of its Invesco QQQ trust holdings held at the Depository Trust and Clearing Corporation. That's over $300 billion in assets, now living on a blockchain. But JPMorgan wasn't alone. The tokenization used the DTCC's new digital infrastructure. The shares remain convertible back to traditional stock at any time. But the key point is that these are real, registered equities, not synthetic derivatives. Why does this matter? Because until now, tokenized stocks were mostly offered by crypto-native firms like Ondo and Securities. They had first-mover advantage by partnering with BlackRock. But now the legacy infrastructure is fighting back. The DTCC's move puts direct pressure on those crypto-native firms. They built their business on being faster than the old guard. Now the old guard has caught up, and they bring trillions in assets with them. The working group behind this service includes BlackRock, Circle, Morgan Stanley, Nasdaq, Kraken parent Payward, and Robinhood Markets. That's a who's who of both traditional finance and crypto. Robinhood's involvement is especially interesting. Just days earlier, Forbes reported that Robinhood's tokenized SpaceX and OpenAI shares sold price exposure, not actual equity. Now they're part of the real deal. Meanwhile, BlackRock didn't stop there. On the same day, they launched two new tokenized money market products, on-chain shares of the BlackRock Select Treasury-based liquidity fund and a stablecoin reserve vehicle. These products combine BlackRock's money market expertise with blockchain infrastructure. They maintain the liquidity and stability of regulated money market funds, but now they're on-chain. This is a direct bridge between TradFi and DeFi. And it's not just stocks and money markets. JPMorgan, Bank of America, Citi, and Wells Fargo are planning a shared tokenized deposit network run by the clearinghouse, set to launch in 2027. Their answer to the open USD stablecoin. This means the biggest banks in America are building their own stablecoin-like system. Tokenized deposits are essentially programmable dollars, but backed by FDIC insurance. This could reshape how money moves. Meanwhile, Coinbase and Better announced that homebuyers can now pledge Bitcoin as collateral for a down payment on a Fannie Mae mortgage. This is a massive step for crypto and real estate. Coinbase billionaire CEO Brian Armstrong believes remittances could cost zero in the future. With tokenized deposits and stable coins, that vision is getting closer. The cost of moving money is dropping to near zero. Meta also rolled out digital dollar payouts for global creators. That means Facebook and Instagram creators can now receive payments in stable coins. Another household name embracing crypto infrastructure. But not everything is rosy. Goldman Sachs restricted Hong Kong staff from using Claude AI, citing data security concerns. Even as they embrace blockchain, they're cautious about AI. Back to the tokenization story. The DTCC move is significant because it uses existing regulated infrastructure. The shares are held at DTCC, and the token represents a legal claim. This is not a Wild West crypto scheme. For comparison, the total market for tokenized real-world assets is projected to reach $16 trillion by 2030. Today's move is the starting gun. Every major bank will now have to offer tokenized products. Circle, the company behind USDC, was also part of the working group. Their stablecoin infrastructure is likely powering the settlement layer. Circle is becoming the plumbing for institutional crypto. Kraken's parent company Payward also participated. That means the crypto exchange is helping to build the infrastructure that could eventually make traditional exchanges obsolete. Irony, right? The New York Stock Exchange's involvement is crucial. They are the oldest stock exchange in America. If they are backing tokenization, it's a signal that the entire system is shifting. What does this mean for retail investors? Eventually, you might be able to buy tokenized Apple or Tesla shares directly on a blockchain, settle instantly, and trade 24/7. No more waiting for market open. But there are risks. The DTCC system still relies on a central authority. It's not a permissionless blockchain. Critics say this is just traditional finance with a blockchain wrapper. But that wrapper enables programmability. Programmability means you can attach smart contracts to stocks. Imagine dividends that pay automatically, or shares that can be used as collateral in DeFi protocols. That's the real innovation here. JPMorgan's tokenization of QQQ is particularly clever. QQQ tracks the Nasdaq 100, which includes Apple, Microsoft, Nvidia, and other tech giants. By tokenizing that, they're effectively tokenizing the entire tech sector. Nvidia itself has been a key beneficiary of the AI boom, and tokenization could allow AI-driven trading bots to directly interact with on-chain stocks. The convergence of AI and blockchain is accelerating. Meanwhile, Bitcoin is languishing, and Michael Saylor's strategy is scrambling to maintain investor confidence. The narrative is shifting from crypto versus Wall Street to crypto as Wall Street. This week's news proves that institutional adoption is not coming, it's already here. The biggest banks, asset managers, and exchanges are all building on blockchain. The question is no longer if but how fast. If you want to stay ahead of these massive shifts, hit subscribe and turn on notifications. We cover the intersection of crypto, AI, and Wall Street every week. Next video, how tokenized deposits could kill stablecoins.